right, let's talk about today's market action. Where we go from here as we celebrate 5 years of a bull market. Joining our exchange today, Anastasia Amoroso from JP Morgan Funds, Jeff Taylor from Digital Risk, Ron Mullenkamp from the Mullencap Fund. We got Mark Tepper from Strategic Wealth Partners, and of course our own Rick Santelli. And folks, I begin our conversation quoting from today's edition of the Financial Times, which quotes reclusive billionaire investor Seth Klarman, who believes that we are building an asset price bubble in the financial markets. He says that any year in which the S&P 500 jumps 32% and the NASDAQ 40%, while corporate earnings barely increase, should be cause for concern, not further exuberance. He says eventually buy the dips will be replaced with what was I thinking? Ron Mullenkamp, I feel the need to go to you. You're a value investor like Seth Klarman. What do you think of that?
Well, what Seth is saying will be true eventually, but the assumption that the market going up 30% when the economy didn't do all that much assumes it was fairly priced a year ago. Frankly, we think a year ago it was discounting a bit higher inflation. Inflation's come in, it's about 1.7. Frankly, we think it's fairly priced for about a 2 to 2.25% inflation. There's all kinds of things out there that can hit it. Though, you know the litany as well as I do.
Yep.
And the bears always have better specific arguments. But the ultimate bull argument is that this country and this economy tends to muddle through. We're no longer finding things cheap, but we're not running for the hills just yet either.
And Mark, Seth has been skeptical of what's going on in markets for some time. In fact, he's called it the Hostess Twinkie market before, saying it's totally artificial ingredients, sort of putting the blame right at the feet of the Fed. And here's what I want to know from your point of view. Is this totally artificial or is it not? Is there something fundamental, whether it's on the corporate earnings side or whether it's with regard to other U.S. demographic factors, et cetera? Is there something fundamental here for a reason to have exposure to this market long term?
Absolutely. I mean, we're watching corporate earnings finally starting to grow again. Now, over the course of the past several years, all we've seen is really a lot of multiple expansion and no earnings growth, but we are seeing the earnings growth start to pick back up. We actually think this market has another 2.5 to 3 years of bull left in it. We really do think that, until there's been at least a few Fed interest rate hikes, we can actually maintain an overweight equity bias really on autopilot. The last two bull markets came to an end when the 10-year Treasury yield began to exceed the nominal GDP growth rate. With that current yield at 2.8%, we've got probably 1.5 to 2% of wiggle room to go. And it looks like the Fed's not going to raise interest rates at all until the end of 2015. And we're probably not going to reach that problem zone until end of 2016, 2017. So we would stay overweight equities.
With all due respect, Mark, when I hear autopilot, I get sweaty palms when it comes to investing. And in fact, Seth Klarman says he feels investors are underplaying risk and not really prepared for the end to the central bank's reversing its 5-year easy money policy. Autopilot, really?
Yeah. I mean, we're long-term investors. We do think, we're making our decisions based on a 3 to 5 year outlook. When we look out 3 to 5 years, there's some great opportunity out there. I mean, the PE ratio right now forward PE ratio is right at around 15. That's within the historical average range, so we're really not overly concerned about how the market's currently priced.
Rick Santelli, if Mark's right, and we have 2.5 or 3 years to go, that means this bull market, historically speaking, will go down as the strongest, if not second strongest, maybe the strongest, longer than 1990 to 2000. How unlikely? Who would have thought we'd be here now? Is it possible that we're only halfway through?
Oh, I think it's possible, but I also think that it's the biggest asterisk in the world. Yes, it'll be maybe have a ways to go, and it could be the biggest bull market ever, but it's the biggest bull market with the biggest ample helping from central banks, ours, a lot of central banks, and I think that really merits looking into because, to me, there's two areas I'd pay attention to now, and one isn't U.S. equity markets. That was the beginning of the year. That softness translated into lower interest rates. But now, I would think when we crossed 139 in the euro versus the dollar, and the euro was strengthening against a variety of currencies, that's really taking something out of the German stock market. And even though all big developed economy stock markets aren't correlating 100%, I can't imagine, should the German stock market start to fall anymore, that we wouldn't see a sympathetic move in global equity markets. So I think you really want to pay attention to the currency markets, whether it's the yuan or the euro. I think this is going to come back and haunt many of the central banks, and it's no coincidence that as the German stock market goes down, all of a sudden some of the tough German finance ministers are actually thinking maybe some American-style QE would be in order. They're looking to weaken their currency.
Yeah, talking about the other options that they have is so true.
Yeah, that prescription's going around these days. Anastasia, what about, and I'll go back to Seth Klarman's premise, that we really are taking for granted the impact that the Fed policy over the next few years is going to have on the financial markets, and we're just expecting it to continue on until they actually begin the process of raising interest rates. Are we being too complacent here, do you think?
Well, I think there's some reasons to remain optimistic, because that's right. As long as the Fed is easy, there is a runway here for acceleration for risky assets. I wouldn't necessarily say that we're completely on autopilot because, amidst the upward trend, we still need to be very careful about picking up those dips, because you'd never know whether it's Ukraine, whether it's Russia, whether it's Venezuela, whether it's China that's causing the pullback, and assessing that pullback. And I think buying the dips approach does absolutely make sense as long as the Fed is easy. So the question is, now that we are almost at 6.5% unemployment rate, how long will the Fed remain easy? And if you look at their expectations of how much they will actually hike that rate, there's no question of when. The when is probably 2015, but there's a question of how much. There's a great dispersion there.
Yeah, and by the way, there's a lot more detail we're getting courtesy of John Hilsenrath as well on what this exit strategy might look like. We heard from the Fed back in 2011 that it would be something like letting the current holdings of mortgage-backed securities sell off, maybe proactively selling some additional assets off the balance sheet. Well, now that may not be the case at all, Jeff Taylor. We're starting to get a sense instead it's going to be about maybe using some of these newer tools, reverse repos, trying to use the price of that interest rate that it uses to lend to banks to affect the price throughout the economy. And in other words, this won't necessarily be telegraphed as far ahead of time unless the Fed wants to tell us so.
I totally agree. If you look right now at last month's home sales, 40% of them were 100% cash. That really tells us that we're still driven in very much an investor market, where if we look to over the next 6 to 12 months, we really want to get to a consumer-driven market. And that's going to come by jobs creation. That's going to come by people being able to afford 10, 15% down on housing. And that's going to get to more even flow of the housing market, where right now, again, it's still very investor-driven.
Ron Mullenkamp, I'm not obsessed with this Seth Klarman thing, but
I think you are a little bit.
I just find it interesting. I think, we all ignore the profit until we don't ignore the profit anymore. One other point, and I think this speaks to you as well, since you're one of the more famous value investors out there. I mean, he's looking at the explosion of stocks like the Netflixes and the Teslas and the Twitters and those things, which, while they're not the rule, they are sort of the exception now, but they do exist in this market environment, in which he says is symptomatic of a market that's becoming frothy right now.
Well, they are not the rule. It is a fairly short list, and yes, there's the outliers. The public is getting scared back into the markets, but we've seen interest rates neutralize. Long interest rates are about where we think they should be given inflation. The normal thing for the economy is to grow, but the economy's not growing. Everybody talks about employment picking up, but as long as there's as much uncertainty on taxes and regulations, there's no incentive for companies to go out and hire. So I think we're still in this very slow growth kind of thing, 2 to 2.5%.
Where do you see value right now?
Longer term, if you want me to get bullish, we can talk about shale gas, we can talk about biotech. We last year did a seminar on shale gas, and actually we put the content of that into a booklet if anybody wants. But we are setting up for a very good decade in the United States. But we still haven't
feeling the Germans will want to read that booklet.
There's a whole lot of people going to
Seth Klarman ought to read that booklet as well.
Yeah, I guess so.
Well, but this is a long-term play. This is a 5 to 10-year play. There's many things that could trip us up and give us a 6 to 18-month downturn in the middle of that. We have not solved any of the basic problems, but the economy does muddle through fairly well.
Yes,
and the markets have been
somehow. All right, folks, thank you all for your thoughts today. Appreciate it. And Seth Klarman, thank you as well for your thoughts.